Have you ever looked at a company's report and thought, wait a minute, how can they make more profit while bringing in billions less in sales? Well, that's the exact puzzle we're going to solve today. We're diving deep into the latest earnings from the agricultural giant Archer Daniels Millen, or ADM. We're going to decode the story behind their numbers and uncover the one kind of surprising factor that's going to shape their entire year.
All right, so at first glance, ADM's latest results, they just don't quite add up. It's like getting a report card with an A+ right next to a D-. It's a real mixed bag, and it presents a pretty fascinating puzzle. So let's start with those big headline numbers. Okay, so here's where things get really interesting. The core contradiction of this whole report. On the one hand, ADM beat expectations on profit per share. That means they were more profitable than Wall Street thought they'd be. Great, right? But on the other hand, they missed their revenue target by a huge margin. So how on earth does a company make more money on the bottom line while bringing in way less money at the top? That's the big question we need to answer.
To solve this thing, we've got to break it down. You can see the profit beat was pretty small, just 3 cents per share. But that revenue miss? Whoa, that was massive, nearly $2.5 billion. A gap that big tells you something important. You can't just look at ADM as one single company. You've got to look at it as a collection of different businesses, all with their own story.
Yeah, the best way to think about ADM is like 3 different companies all operating under one giant roof. And to really get what happened in 2025, we have to look at each one's individual story. Because trust me, they each had a completely different year.
So first up, we've got their biggest segment by far, ag services and oilseeds. This is the traditional core of their business. Buying, storing, and processing crops like soybeans. And in 2025, this giant really struggled. It faced some serious headwinds.
This part of the company was hit by a perfect storm of issues. North American exports were down, and the profit margin they make on crushing soybeans into oil and meal was just weak. Plus, they got smaller insurance payments than they did the year before. So what's the result of all that? A 34% drop in annual operating profit. That is a major drag on the whole company. Next, let's turn to their carbohydrate solutions business. This is the division that turns corn into things like sweeteners, starches, and ethanol. And its story is like a perfect balancing act, with 2 powerful opposing forces pulling in different directions. So on one side, you had sales of sweeteners falling because people were buying fewer packaged goods. That's a negative. But on the other side, the ethanol business was just on fire. Profits from their Vantage corn processors unit shot up an incredible 187% in the fourth quarter. It was such a huge surge that it almost completely balanced out the weakness from sweeteners. Pretty wild.
And that brings us to the third piece, the nutrition segment. This is ADM's high-growth division, the one focused on trendy things like natural flavors and plant-based proteins. And after some really big challenges, this part of the business is finally in comeback mode.
Now, the good news here is that the underlying business is getting back on its feet. A really key plant that was shut down is back online, and sales of their high-value flavors are growing again. Now, you might look at the numbers and see that fourth quarter profit was down, but that's a bit misleading. That's only because the year before, the number was artificially inflated by a big one-time insurance payout. The actual day-to-day business is getting stronger.
So, there you have it. That's the complex story of 2025. You've got a struggling core business, a balancing act in carbs, and a recovering nutrition arm. But the real question is, what does ADM see when it looks down the road to 2026?
The company is projecting growth. They're guiding for earnings somewhere between $3.60 and $4.25 per share. But look closely at that. The real story isn't the numbers themselves. It's the huge gap between the low end and the high end of that range. That 65-cent spread is massive. It screams one thing: uncertainty. And that uncertainty leads us directly to the biggest piece of this entire puzzle. What is the one thing, the single factor, that could swing the company's results so dramatically from one end of that guidance to the other? Well, it all comes down to one critical wildcard.
So what is it? What single variable explains all this uncertainty? It's not the weather, it's not crop yields, it's not consumer demand, it's government policy.
The answer comes down to just 3 letters: RVO. That stands for the Renewable Volume Obligation. To put it simply, this is a U.S. government rule that dictates exactly how much biofuel, like ethanol, has to be mixed into the country's gasoline and diesel supply. This rule single-handedly drives a huge amount of demand for ADM's ethanol and their vegetable oils for biodiesel.
And hey, you don't have to take my word for it.
On their earnings call, ADM's own CEO, Juan Luciano, said it himself, plain as day. The company's results for 2026 are, and I'm quoting here, highly dependent on when the government finally provides some clarity on this policy and, of course, how big that new mandate will be. Pretty much everything is riding on that one decision.
So, what does this all mean? The biggest takeaway is this. If you want to understand the future of this massive agricultural company, you need to look beyond the farm fields and focus squarely on Washington, D.C. A huge chunk of the company's fate rests on a single government policy decision.
And this brings us to a final thought to chew on. The ADM story isn't just about commodities and supply chains. It's a really powerful example of just how deeply business and government policy are tied together. And it leaves us with a fundamental question to ask ourselves. When a company's future depends this much on a regulatory decision, are you investing in a business or are you actually making a bet on politics?